Uncertainty is the market right now, not as a buzzword, but as a literal description of the environment. Nobody knows how the war in the Gulf resolves, nobody knows what the Friday jobs number does to the dollar, and nobody knows if the next headline sends oil to $100 or back to 70. In this climate, patience is not weakness, patience is your only edge. This market will find every crack in your plan and widen it. Short-term traders who say, "I'll figure out the exit when I get there," will be liquidated. The survivors are those who knew exactly what they were doing before the price moved. As of this recording, silver is sitting at $83 on the paper markets. It pulled back from its high of $86.90. But while the Western paper price sits at 83, Shanghai is trading at $95. That is a $12 premium. The paper price is one story, the data underneath is another. Let's start with the COMEX open interest. Total open interest has fallen to 113,326 contracts. To put that in perspective, the all-time high was over 244,000 contracts set in February of 2020. We are looking at the lowest participation levels since 2013. The gamblers are walking out of the casino. But here is the open loop that should terrify the shorts. When a rigged casino loses its players, it loses its power to set the price. Total silver inventory on the COMEX now stands at 352 million ounces, a fresh one-year low. Nearly 3 million ounces left the exchange in a single day. In the last 30 days alone, the vault has drained by 13%. If the paper market is shrinking, but the physical metal is vanishing at a record pace, what happens when the registered leverage ratio hits its breaking point? Currently, for every ounce of physical silver in the registered vault, there are 6.5 ounces of contractual obligations stacked on top of it. We are about to look at the massive delivery notices issued on Tuesday and why Goldman Sachs and Macquarie are suddenly standing for physical metal. On Tuesday alone, 607 silver delivery notices were issued. Goldman Sachs issued 400, Macquarie issued 200. On the stopping side, meaning the ones taking the metal, Bank of America took 195 contracts and JP Morgan took 145. Total COMEX March silver deliveries have climbed to over 28 million ounces. These are not retail stackers buying coins. These are massive institutions using the formal delivery mechanism to pull physical silver off the exchange. On the gold side, it's even more aggressive. Over 1,200 delivery notices were issued on Tuesday. The institutions are not rolling their positions into the next paper contract. They are standing for the metal. Here is the part that makes these inventory numbers even sharper. Since February 9th, retail investors have actually sold roughly 15 million ounces of physical silver. In a healthy market, that selling should have eased the pressure. It didn't. Silver lease rates are still elevated and the one-year swap rate is still distorted, pricing in backwardation risk. Retail liquidated 15 million ounces, and the stress signals didn't move an inch. This means the paper markets are no longer just failing to price scarcity. They are actively suppressing it. But here is the open loop for the East. While the West suppresses the price, the Shanghai Futures Exchange has seen its silver inventories fall to just 9.5 million ounces. At the current withdrawal rate, the Shanghai Exchange will be completely empty in 24 days. The combined Chinese silver inventory across both major exchanges is at its lowest level in a decade. If China runs out of silver in 24 days, and the Western paper price is $12 lower than the Eastern physical price, where does the metal come from? The answer involves a $1 billion position held by a firm built for volatility, Jane Street. We are about to look at the massive accumulation by the world, its new silver whale, and the pattern they've used before in the crypto markets. According to the latest SEC filings, Jane Street added 20,600,000 shares of the iShares Silver Trust, the SLV, in the fourth quarter of 2025. That is a 500-fold increase in a single quarter. The position is now worth approximately $1.3 billion, making Jane Street the largest reported holder of SLV, even larger than the fund's sponsor, BlackRock. During the same period, Morgan Stanley reduced its position, and BlackRock added 0. Now, keep in mind that over 87% of Jane Street's portfolio is tied to options. They are a firm structurally built to profit from volatility. When a firm with that architecture becomes the dominant owner of a physically backed silver fund, you have to ask, which direction is the volatility bet? Is this a massive long position, or is it the other side of a structured trade designed to profit from price suppression while holding the dominant paper stake? The custodian of the SLV is JP Morgan, the same bank that paid $920 million in 2020 to settle the federal charges related to 8 years of precious metals spoofing. That is a settled federal case, not a theory, but here is the open loop that connects this to the broader market. Traders are identifying price action patterns in silver that look identical to patterns previously seen in Bitcoin, patterns allegedly tied to Jane Street that reportedly vanished the moment the Terraform lawsuit became public. Jane Street is currently facing allegations across 3 separate asset classes: the Terra collapse, manipulation findings in India, and the 10 a.m. Bitcoin dump pattern. As the scrutiny builds, we have to look at the energy convergence happening simultaneously. We are staring at 3 simultaneous energy threats: Iran, Qatar, and Russia, that are about to reprice the entire world. If $1 billion a day is being spent on naval intercepts in the Gulf, how long before the energy market forces the silver market to break? The specific Iranian threat against a nuclear reactor may be the final trigger. As of this recording, 3 energy threats are active simultaneously. First, Iran. The Strait of Hormuz carries 20% of global energy supply. The Pentagon estimates the war is currently costing $1 billion per day. Iran has the capacity to produce 10,000 drones a month at a cost of $35,000 to $50,000 each. The U.S. intercept cost is $1 million to $3 million per missile. This is an unsustainable equation. Iranian officials have now publicly stated that if the U.S. and Israel pursue regime change, they will target the Dimona nuclear reactor and all regional energy infrastructure. This is a named public threat against specific targets. Second, Qatar. 20% of the global liquefied natural gas supply went offline today. Coal futures immediately surged over 7% as the power sector scrambled for alternatives. When LNG disappears, coal fills the gap. Third, Russia. Vladimir Putin has raised the possibility of rerouting Russian gas away from Europe entirely. But here is the open loop that the mainstream is missing. Goldman Sachs has stated that if the Hormuz disruption holds for 5 more weeks, Brent oil will hit $100. But that projection only assumes the Hormuz disruption. It does not factor in Qatar and Russia being offline at the same time. What happens to the price of every manufactured good on the planet when all 3 energy pillars collapse at once? We are about to look at the 1970s parallel, the only blueprint we have for a world of energy scarcity and monetary debasement, and why Donald Trump's move on Venezuela reveals the true desperation of the Western energy complex. The best performing assets of the 1970s were oil, precious metals, and chemicals. That decade was defined by energy shocks, geopolitical fragmentation, and stagflation. It is your blueprint for the next few years. The structure rhymes: energy scarcity, monetary debasement, and physical assets outperforming paper promises. The mainstream will tell you this time is different, but the charts of the Hang Seng, the KOSPI, and the Dubai markets, all hitting limit down recently, suggest otherwise. In the midst of this, we saw a massive headline. Venezuelan oil is reportedly flowing again after a sudden announcement from the Trump administration. Ask yourself, why move so quickly on a regime that was previously a pariah? It's because if Hormuz is tight, Qatar is offline, and Russian gas is rerouted, you need every alternative barrel you can find. But there is a problem. Venezuelan output cannot offset a Hormuz disruption. Trump already ordered naval escorts through the strait, and the oil market rejected the move. Prices recovered every cent of the peace dip within hours. But here is the open loop that should keep every short-term trader awake tonight. While the long-term fundamentals are screaming scarcity, the short-term price action is a literal minefield. The DXY dollar index is consolidating at a level that could trigger a forced liquidation across all asset classes, including gold and silver. If you're trading with leverage right now, you aren't analyzing. You are gambling in a room full of professionals who are waiting for you to blink. We are about to reveal the honest resistance case, and the 2 specific economic reports hitting on Thursday and Friday that could either ignite the next leg up or send the paper price of silver back to the $70 range. Let guests be honest. Silver came off its high of $86.90 and is sitting at $83. The dollar is consolidating. Short term, the picture is genuinely unclear. I will not pretend otherwise. As of this morning, Thursday, March 5th, 2026, the DXY dollar index is hovering near 99, up 0.20%. It is challenging the 100 mark. If it breaks through, expect a forced liquidation event across all dollar-priced assets. This morning, all eyes are on the initial jobless claims report at 8:30 a.m. The market is looking for 215,000 filings. If the number is lower, the dollar gains strength, and the paper slam on metals continues. If the number is higher, the growth scare accelerates, and the industrial demand narrative for silver takes another hit. This is the definition of a minefield. Tomorrow, Friday, March 6th, we face the non-farm payrolls report. Consensus is looking for only 60,000 new jobs, a massive deceleration from January's numbers. This is high-impact dollar-correlated data. Consolidation before these releases often looks like accumulation, but it can resolve in either direction with extreme violence. I would not be trading with leverage here. For the long-term stackers, ignore the screen and watch the Shanghai withdrawal rate. As of March 4th, Silver inventory on the Shanghai Futures Exchange fell again to roughly 295 tons. We are watching the most significant physical drain in a decade. But here is the final open loop as we close this briefing. While the Western paper price is being held down by the dollar ES strength, a sovereign fund in the Middle East has just quietly increased its physical gold to silver allocation target to a record level. They aren't waiting for the jobs report. They are buying the physical metal at a $12 premium in the East, while the West is busy trading paper. If the DXY fails to break 100 after the payroll data, the paper wall will vanish in a single session. Invest with logic, not hype. OG out and about.